Why do most investors limit themselves to just one type of compounding when there are 4 proven strategies that could multiply their wealth much faster? In the next few minutes, you'll learn about dividend reinvestment, time in the market, monthly contributions, and dividend growth, each with the power to accelerate your financial growth. Imagine turning $100,000 into $58 million by combining these methods over time. Which of these methods have you tried, and which could be the hidden key to your financial freedom? If you're serious about growing real wealth, hit like so YouTube knows to show this to more investors just like you. Let's start by exploring the first strategy that lets your money work for you even while you sleep. Dividend reinvestment is one of the most overlooked engines for building wealth. When you enable this feature, often called a dividend reinvestment plan or DRIP, your dividends are automatically used to buy more shares of the same stock or fund. Each new share then earns its own dividends, which get reinvested again, creating a powerful snowball effect. Over time, this cycle can accelerate your portfolio's growth far beyond what most investors expect. But here's the catch: many people never take advantage of DRIP. If you don't activate it through your brokerage, your dividends just arrive as cash and sit there, not working for you. That stops the compounding right in its tracks. For anyone serious about long-term growth, enabling dividend reinvestment is a simple but critical step. You don't have to monitor the market or make constant decisions. Just set it up once and let the compounding process unfold automatically. Let's see how this works with a real example. Imagine Harry, an investor who puts $50,000 into SCHD, a fund focused on high-quality dividend stocks, and another $50,000 into Realty Income, famous for its monthly payouts. At the outset, SCHD yields 3.71% with quarterly dividends, while Realty Income offers a 5.62% yield and pays monthly. With DRIP turned on, every dividend payment, whether quarterly or monthly, buys Harry more shares, which then generate more dividends. After 10 years, Harry's $50,000 in SCHD has grown to $155,000, and his $50,000 in Realty Income has reached $76,000. That's a combined portfolio of $231,000, more than doubling his original investment. Fast forward to 20 years, and those numbers jump dramatically. SCHD climbs to $482,000, Realty Income to $620,000. Together, that's over $1.1 million. By the 30-year mark, Harry's initial $100,000 has become $1.5 million in SCHD and $2.2 million in Realty Income, totaling $3.7 million. All of this growth came from simply reinvesting dividends with no extra cash added and no need to time the market. What makes this possible is the compounding effect. Each dividend payment is like a small seed, and when you invest it, you're planting more seeds that will grow and produce even more dividends. The process accelerates as your share count increases. More shares mean more dividends, and the loop keeps repeating. Studies show that reinvested dividends have accounted for roughly 1/3 of the S&P 500's total return over the past few decades. Without reinvesting, the returns just wouldn't be the same. It's also worth noting that the frequency of dividend payments matters. Realty Income's monthly payouts give Harry more frequent opportunities to reinvest, which speeds up the compounding effect even further. Whether your dividends arrive monthly or quarterly, the key is to keep them working for you instead of letting them sit idle as cash. The best part is that this strategy is accessible to anyone. You don't need a massive portfolio to benefit from dividend reinvestment. As long as you enable DRIP in your brokerage account, you can start compounding your dividends right away. The earlier you start, the more time your investments have to grow. Dividend reinvestment is a powerful tool, but it's just one way to harness the magic of compounding. There are other strategies that can multiply your returns even further, especially when you combine them. So what happens if you add another layer to your wealth building approach? Sometimes the most powerful wealth-building strategy is also the simplest: staying invested for the long haul. Time in the market, the second type of compounding, relies on patience and the steady growth of the broader economy and great companies. Instead of chasing quick wins or reacting to every headline, this approach is about letting your investments work quietly in the background, compounding year after year. History shows missing just a handful of the market's best days can wipe out much of your gains. So resist the urge to time exits or panic buys. The biggest rewards go to those who stick to high-quality investments and give them as much time as possible to grow. It's easy to get spooked when markets drop or to want to cash out after a big run-up, but the data is clear. Jumping in and out often leads to disappointing results. To see this in action, let's check back in with Harry. He decided to put $70,000 into VOO, the Vanguard S&P 500 ETF, and $30,000 into Apple stock. These choices show two sides of time in the market. VOO offers steady, diversified exposure to 500 of America's largest companies. Since its launch in 2010, VOO has returned 12.82% annually, showing how consistent broad exposure pays off. Apple, on the other hand, represents the potential of holding a single, exceptional company for decades. Over the past 20 years, Apple has delivered a remarkable 29.8% annualized return. After 10 years, Harry's patience started to show results. His $70,000 in VOO grew to $232,000. Meanwhile, his $30,000 in Apple reached $36,000. Solid growth, but nowhere near the explosive gains that came later. The real magic of compounding is that it accelerates over time, so the longer you stay invested, the more dramatic the results become. By the 20-year mark, the impact of time in the market became even more obvious. VOO continued its steady climb, reaching $770,000. Apple, benefiting from its exceptional performance, soared to $5.55 million. Together, Harry's portfolio totaled $6.32 million. This leap shows what happens when you give great investments the time they need to grow and let compounding do its work. At 30 years, the numbers become even more striking. VOO, reflecting the growth of the U.S. economy and its largest companies, reached $2.55 million. Apple, thanks to decades of innovation and expansion, skyrocketed to $55.5 million. Combined, Harry's portfolio stood at an astonishing $58 million. And that $58 million number, that's just one piece of the puzzle. Imagine layering on dividend reinvestment or regular contributions next. What's important here is that Harry didn't try to time the market or add extra money along the way. He simply held on to quality assets and let time do the heavy lifting. VOO's performance shows the value of broad diversification, while Apple demonstrates what's possible when you commit to a truly exceptional company. Together, they capture the essence of time in the market compounding, consistency, patience, and the willingness to let your investments grow uninterrupted. The lesson is clear. Patience and consistency are two of the most underrated tools in investing, but they're not the only ones. There's another straightforward strategy that can multiply your results, one that doesn't require a big starting amount, but instead relies on small, regular steps. If you've ever wondered how steady contributions could change your financial future, you'll want to see what's next. Building wealth doesn't always require a huge upfront investment or a lucky break in the market. Compounding contributions, building wealth 1 month at a time, offers a practical, disciplined path that anyone can follow. By making regular, fixed investments, you steadily grow your portfolio, harnessing the power of consistency and time. This approach, also known as dollar cost averaging, means you invest the same amount every month regardless of what the market is doing. It's a strategy that takes emotion out of the equation. Instead of worrying about whether now is the perfect moment to invest, you simply keep adding to your holdings. Over time, this smooths out volatility since you buy more shares when prices are low and fewer when they're high. The result is a lower average cost per share and a portfolio that builds steadily even through market ups and downs. Harry put this strategy to work by combining both growth and stability. He started with $60,000 in DGRO, the iShares Core Dividend Growth ETF, and $40,000 in Procter & Gamble, a company known for over 50 consecutive years of dividend increases. But the real engine was his commitment to add $1,000 every month, $600 to DGRO and $400 to P&G, no matter what the market was doing. DGRO has achieved an 11.6% 10-year compound annual growth rate, while P&G boasts a 4.6% annual dividend growth rate, making both ideal for long-term accumulation. The numbers speak for themselves. By 10 years, his portfolio reached $709,000 on $220,000 invested. By 20 years, it soared to $1.95 million on $340,000 invested. At 30 years, it topped $4.46 million from $460,000. All of this growth came from a simple plan, steady contributions, and patience. Harry didn't need to invest a fortune at the start. He just kept adding reasonable amounts over time, letting compounding do the heavy lifting. What's striking is how this steady approach multiplies wealth even for those without a massive lump sum to start. The discipline of monthly investing builds a habit that pays off in the long run. As the portfolio grows, so does the impact of compounding. Every new dollar added has the potential to generate returns for decades, and as those returns stack up, your wealth accelerates. The choice of investments matters too. DGRO focuses on companies with a strong record of dividend growth, providing a dynamic mix of income and appreciation. P&G, as a dividend king, adds stability and a predictable stream of rising dividends. Together, they form a solid foundation for anyone looking to grow wealth through regular contributions. The blend of growth and reliability means your portfolio isn't just getting bigger, it's also becoming more resilient. Beyond just portfolio growth, there's another benefit: rising income. Harry's consistent contributions didn't just increase his net worth, they set him up for a growing stream of dividend payments. As DGRO and P&G raised their dividends year after year, the income from his portfolio grew too. This means greater financial flexibility and the potential for genuine passive income over time. Compounding contributions prove that you don't need perfect timing or a huge windfall to build serious wealth. The secret is in sticking to a plan, making regular investments, and letting time work its magic. Even if the market is volatile, the steady rhythm of monthly contributions keeps you on track and helps you avoid emotional mistakes. We've seen how regular contributions build wealth steadily. Next, let's see how increasing dividends themselves can turbocharge your income. Imagine a strategy where your income doesn't just arrive each year, it grows larger and larger automatically. That's the core of dividend growth compounding. Instead of chasing the highest yields, too many investors miss the real power: rising payouts that steadily transform a portfolio into a wealth-generating machine. Let's break it down with a real example. Harry, having already benefited from reinvesting dividends and long-term investing, decided to focus on companies that consistently raise their dividends. He started with $60,000 in NOBL, the ProShares S&P 500 Dividend Aristocrats ETF, which only includes companies that have increased their dividends for at least 25 consecutive years. Alongside that, he invested $40,000 in Microsoft, a stock that's delivered for over a decade of dividend hikes and strong price appreciation. This mix gave Harry both stability from established dividend payers and the explosive upside of a high-growth dividend stock. After 10 years, the results were clear. NOBL grew to $148,000 and Microsoft climbed to $432,000. Combined, Harry's portfolio reached $580,000 and his annual dividend income jumped from $1,200 to $8,500. At first, the increases might look modest, but the real power of dividend growth compounding is how it accelerates over time. By the 20-year mark, the effect became even more dramatic. NOBL, with its focus on dividend aristocrats and a 10-year annualized return of 9.5%, reached $3.16 million. Microsoft, with a 27.95% annualized return and a 10.35% average annual dividend growth rate, soared to $4.68 million. Together, the portfolio topped $5.04 million. More important than the balance, though, was the income. Annual dividends had grown to $35,000, all without Harry needing to reinvest or contribute more money. This is the unique benefit of dividend growth compounding. Your income stream expands on its own. After 30 years, Microsoft surged to $50.4 million and NOBL to $894,000, creating a $51.3 million portfolio and $280,000 in annual dividends. At this stage, Harry's portfolio didn't just provide financial security. It delivered a stream of income that could support any lifestyle, all passively. What makes this strategy so effective? It's the combination of share appreciation and steadily rising dividend payouts. NOBL's focus on companies with 25-plus years of dividend growth means it holds mature, reliable businesses, while Microsoft shows how high-growth companies can amplify both capital gains and dividend income. By blending both, Harry captured stability and exceptional growth, illustrating the versatility of dividend growth compounding. And because dividend payouts rise, this strategy helps your income keep pace with inflation, something fixed income investments can't match. As the cost of living increases, so does your dividend income, which is especially valuable in uncertain or inflationary times. It's tempting to focus on companies offering the highest yields, but that approach often comes with risk. High-yield stocks might not grow their payouts, and even some cut dividends during tough stretches. Dividend growth champions, by contrast, have a proven record of raising payouts year after year, weathering various market cycles. This reliability is what makes dividend growth compounding a cornerstone for long-term investors. When you layer dividend growth on top of other compounding strategies, reinvesting dividends, staying invested for the long haul, and making regular contributions, you create a powerful engine for both wealth and income. Each strategy amplifies the others, making your results even stronger. Up till now, we've grown wealth and income. But what if you could keep more of those gains? There's a tax-free twist next. Combined dividend reinvestment, time in the market, regular contributions, and dividend growth, and you've got a compounding engine that can turn $100,000 into $3 to $5 million over 30 years. These four strategies work together to build real wealth, even if you start small. The key is to stay consistent and give your investments time to grow. And when you use tax-advantaged accounts like a Roth IRA or TFSA, you can keep that growth completely tax-free. Another reason the wealthy lean into these tools. If you found this useful, hit like, subscribe, and comment below which compounding strategy you'll start using today.